Dell Technologies has transformed from a traditional PC and enterprise hardware company into one of the major infrastructure beneficiaries of the artificial intelligence boom. The key investment story today is no longer just laptops and PCs. It is AI-optimized servers, data center infrastructure, storage, networking, and the massive amount of hardware required to build modern AI systems. Dell's first quarter fiscal 2027 results showed just how powerful this transition has become, with revenue reaching $43.8 billion, up 88% year over year, while AI server revenue reached $16.1 billion. As of August 18, 2026, Dell was trading around $466.70, after closing at $479.81 on August 17th. The stock recently reached a 52-week high of $514, meaning investors have already priced in a significant portion of the AI growth story. Dell's current market capitalization is roughly $300 billion. This is important because Dell is no longer a low-growth value stock, trading at a modest valuation. The market is increasingly treating Dell as an AI infrastructure growth company, and that means future earnings growth has to justify a much higher valuation. Dell operates primarily through its Infrastructure Solutions Group and Client Solutions Group. The infrastructure business includes servers, storage, networking, and related enterprise solutions, while the client business includes PCs, workstations, and peripherals. Historically, Dell's PC business was the better-known part of the company, but AI is rapidly shifting the center of gravity toward infrastructure. The biggest opportunity is AI servers. Cloud providers, enterprises, governments, and other organizations are spending enormous amounts of money building AI data centers. Dell provides the servers and infrastructure that allow customers to deploy powerful AI accelerators, including systems built around NVIDIA's latest platforms. This makes Dell an important second-order beneficiary of the AI boom. This is arguably the most important slide in the entire Dell investment thesis. During first quarter fiscal 2027, Dell booked $24.4 billion in AI orders and recognized $16.1 billion of AI server revenue. The company exited the quarter with a record AI server backlog of approximately $51.3 billion. Management also increased its fiscal 2027 AI-optimized server revenue expectation to approximately $60 billion. That is a massive increase from the roughly $50 billion expectation given only a few months earlier. If Dell can convert a large portion of this backlog into revenue while maintaining reasonable margins, AI infrastructure could become the primary engine of the company's earnings growth. Dell generated a record $113.5 billion of revenue in fiscal 2026. At the beginning of fiscal 2027, management initially expected revenue of $138 to $142 billion. But after the explosive first quarter, management dramatically increased the outlook to $165 to $169 billion, with a midpoint of $167 billion. That represents roughly 47% growth at the midpoint compared with fiscal 2026. For a company of Dell's size, sustaining anything close to 40% to 50% revenue growth is extraordinary. The key question is whether this growth can continue beyond fiscal 2027 or whether AI infrastructure spending eventually normalizes. Revenue is only half of the story. Investors ultimately need earnings and free cash flow. Dell's first quarter fiscal 2027 adjusted EPS was $4.86, significantly above the consensus estimate of roughly $2.96. Management also raised its fiscal 2027 earnings expectations, reflecting stronger AI server demand, operating leverage, and the company's ability to scale its business. The original fiscal 2027 non-GAAP EPS guidance was approximately $12.90, while subsequent guidance moved materially higher following the first quarter results. This is where Dell becomes particularly interesting. If revenue grows rapidly, while operating expenses do not grow at the same rate, earnings can potentially grow faster than revenue. Dell is also generating substantial cash. During first quarter fiscal 2027, The company generated a record $4.1 billion of cash flow, while returning approximately $2.1 billion to shareholders. The company has historically used a combination of dividends and share repurchases to return capital to shareholders. Buybacks can be particularly powerful when earnings are rising, because reducing the share count allows earnings per share to grow faster than net income alone. However, investors should remember that AI infrastructure also requires substantial working capital and supply chain investment. Strong revenue growth does not automatically translate into equally strong free cash flow growth. Dell's biggest competitive advantage is its scale and enterprise relationships. Building AI infrastructure is complicated. Customers need servers, storage, networking, cooling, software integration, supply chain management, and ongoing support. Dell already has relationships with large enterprises and data center customers, giving it a distribution advantage that newer competitors may struggle to replicate. Its global supply chain and ability to assemble large quantities of complex infrastructure also become increasingly valuable as AI deployments grow. However, Dell does not operate in a monopoly. Companies such as Supermicro, Hewlett-Packard Enterprise, Lenovo, and other infrastructure providers are competing for the same AI spending. The biggest concern with Dell's AI opportunity is that enormous revenue growth does not necessarily mean enormous margins. AI servers contain extremely expensive components, particularly advanced GPUs and related infrastructure. Dell operates in a competitive hardware market, so customers have significant negotiating power. Component costs, supply shortages, pricing pressure, and product transitions could therefore limit profitability. This is why investors should watch gross margin and operating margin just as closely as revenue. A scenario where revenue grows 50% but margins deteriorate substantially would be much less attractive than a scenario where revenue grows 30% while profitability expands. At roughly $467 per share, Dell is no longer obviously cheap based on historical valuation metrics. Google Finance currently shows Dell with a P/E ratio in the high 30s and a market capitalization around $300 billion. But traditional valuation metrics can be misleading during a rapid earnings growth cycle. If Dell's earnings continue expanding rapidly, today's P/E multiple could decline naturally as earnings catch up with the share price. The bigger question is what multiple investors will be willing to pay in 2027. If the market continues to view Dell as a major AI infrastructure company, a premium multiple could be justified. If AI growth slows, however, the stock could experience significant multiple compression. For my base case scenario, I would assume Dell successfully converts much of its AI backlog into revenue, AI infrastructure remains strong, and earnings continue growing rapidly, but at a slower rate than the explosive first half of the AI cycle. Under this scenario, Dell could reasonably move toward a 2027 price target of approximately $550 to $600. That would represent continued upside from current levels, but not another explosive multi-100% rally. The reason I would not assign an extremely aggressive target to the base case is simple. Dell has already experienced a tremendous re-rating in 2026, so future returns will depend increasingly on actual earnings growth. In the bull case, AI infrastructure spending remains extremely strong through 2027. Dell continues receiving massive orders, supply constraints improve, margins hold up better than expected, and earnings estimates continue moving higher. If those conditions occur, Dell could potentially reach $650 to $725 during 2027. A move toward the upper end of that range would require investors to maintain a premium valuation while Dell delivers exceptional earnings growth. It is possible, but it should be considered an optimistic scenario rather than the most likely outcome. The bear case is different. Suppose AI infrastructure spending slows, hyperscalers reduce capital expenditure, GPU availability improves enough to pressure server pricing, and Dell's margins decline. In that environment, Dell could see both earnings estimates and its valuation multiple fall at the same time. My bear case valuation would therefore be around $350 to $400. That would still leave Dell as a major technology company, but the stock could experience a significant correction from current levels if the market starts questioning the sustainability of AI infrastructure growth. My 2027 valuation framework would therefore look approximately like this. Bear case, $350 to $400. Conservative case, $450 to $500. Base case, $550 to $600. Bull case, $650 to $725. Extreme bull case, $750 or higher. The most important point is that these targets are scenario-based rather than guaranteed predictions. Dell's actual result will depend heavily on AI server demand, backlog conversion, margins, cash generation, and the valuation multiple investors assigned to AI infrastructure companies. There are 5 numbers I would watch most closely over the next several quarters. First is AI server orders. Second is AI server backlog. Third is total revenue growth. Fourth is gross margin. And fifth is free cash flow. The upcoming fiscal second quarter report on September 3rd will be particularly important because investors will want to see whether the extraordinary first quarter momentum is continuing. If Dell continues beating expectations and raising guidance, the bullish thesis becomes stronger. But if revenue growth slows sharply or margins disappoint, the current valuation could become difficult to justify. So, is Dell Technologies a buy for 2026 and 2027? I would rate Dell as a buy for long-term investors, but with a more cautious approach after its enormous 2026 rally. The fundamental story is extremely strong. Dell has record revenue, rapidly expanding AI server demand, a massive AI backlog, improving earnings, and significant cash generation. The company has also dramatically increased its fiscal 2027 revenue outlook from the original $138 to $142 billion range to $165 to $169 billion. The biggest risk is valuation. At around $467, investors are already expecting substantial future growth. Therefore, I would not view Dell as a low-risk bargain at today's price. Instead, I see it as a high-quality AI infrastructure company where future returns will depend on continued earnings beats and guidance increases. Overall, Dell has one of the strongest AI infrastructure stories outside of the major semiconductor companies. The company is benefiting from enormous AI data center spending without needing to manufacture the GPUs themselves. If AI capital expenditure remains strong, Dell could continue benefiting from one of the biggest technology investment cycles in history. For my 2027 framework, the base case target is $550 to $600. The bull case is $650 to $725, and the bear case is $350 to $400. At current levels, the risk-reward is attractive enough for a buy, but investors should be prepared for significant volatility because expectations are already extremely high.